Welcome to Compasscope. Our research platform covers over 1,100 public companies. Each week, we share one of our active research files here in dialogue format.
What if I told you that the absolute undisputed king of the American beer market isn't, well, an American brand at all? I mean, when you picture beer dominance in the U.S., you probably imagine like giant, sprawling factories in the Midwest,
Well,
right?
sure, yeah. Millions of red, white, and blue cans.
Exactly. And just this relentless focus on those mainstream, middle-of-the-road domestic lagers.
Right. Well, it's the classic volume playbook.
Huh.
The industry standard has always been to just brew an ocean of standard domestic lager and push it into every corner store and dive bar in the country.
Yeah, but the company we're looking at today, they practically ignore that classic American playbook entirely. I mean, they dominate the market by playing a completely different game. So welcome to another deep dive.
Glad to be here.
Today, we are looking under the hood of Constellation Brands. You'll often see them under the ticker symbol STZ. If you track business models or watch the markets, this one is just a masterclass in carving out a wildly profitable moat.
It really is.
We're pulling from a fantastic stack of sources today for you. Primarily, a brand new comprehensive research report from Compasscope, dated June 5, 2026, alongside the raw transcript from the company's recent Q4 2026 earnings call.
Yeah, and our mission today is to break down the actual mechanics of STZ's unique business. We're going to examine their core lines of business, analyze how they defend their turf against massive global competitors, and, dissect their growth strategy.
Right.
But we also need to look at the massive execution risks they face, dive into their latest real-time business updates, and finally, lay out the key metrics you really need to watch moving forward.
Let's start with the actual business lines, because how STZ categorizes itself is almost a little deceptive, I think.
Yeah, it is.
Technically, they're billed as a beer, wine, and spirits company.
Right.
But when you look at the Compasscope report and see where the cash actually flows, that label really masks what the engine of this company actually is.
Oh, it severely understates their main driver. I mean, their economic engine is incredibly concentrated. Over 90% of their revenue comes exclusively from their beer segment.
Over 90%.
Yeah, over 90. And it's not a wide variety of beer either. They are hyper-focused on high-end and imported Mexican beer sold strictly into the U.S. market.
Right. They hold the exclusive perpetual U.S. rights to some absolute heavyweights. Like, we're talking about Modelo Especial, which is currently the #1 beer brand by retail dollars in the entire United States.
Exactly. Plus the whole Corona family, Pacifico, and Victoria.
And they're aggressively innovating within that very specific Mexican import lane, right? Like, they aren't just shipping classic glass bottles anymore.
No, not at all. They've expanded into the flavored and spiced beer category with Modelo cheladas. And, they're targeting the health-conscious demographic with low-calorie options like Modelo Oro and Corona Premier.
Oh, nice.
Yeah, and they're even stepping into the non-alcoholic space now with Corona Sunbrew.
Wait, I want to pause on the production side of this, actually, because the geographic setup is wild to me. Every single drop of this beer is brewed in Mexico, correct?
Every single drop, yeah. They operate massive brewing facilities in Nava and Obregón, and they are currently ramping up a brand new facility in Veracruz.
Wow.
But, the real secret to their margins isn't just the brewing. It's the vertical integration. They actually own 50% of a massive glass manufacturing facility right next to their Nava brewery.
Which makes total sense when you think about the physics of shipping. I mean, glass is incredibly heavy, it's fragile, it takes up a lot of physical volume.
Oh, absolutely.
It must cost an absolute fortune to ship empty glass bottles across an ocean or across a continent.
Yeah.
So by making the glass right next door to the brewery, they just strip out a massive logistical expense that most competitors just have to swallow.
Right. That structural cost advantage is staggering. Glass makes up roughly 60% of their packaging. So by controlling that supply locally, they insulate themselves from a lot of global supply chain shocks.
So, okay, if 90% of their money comes from this highly optimized Mexican beer machine, what is happening with their wine and spirits segment?
Well, it's essentially a shrinking side project at this point. It accounts for only about 9% of their fiscal year 2026 sales.
Just 9%?
Yeah. Management has been actively divesting their mass market, cheaper wine brands. They're intentionally shrinking that portfolio to focus purely on high-margin, premium names like Kim Crawford for wine or Mi Campo for tequila.
So wait, if I'm picturing their portfolio, rather than trying to be a giant grocery store beverage aisle with a brand for every single person, STZ is like a highly curated premium boutique.
That's a great way to look at it.
Right, like they aren't selling the cheap stuff, they just want to own the top shelf.
Exactly. That boutique approach is the defining characteristic of their business model. They're totally willing to walk away from sheer volume if it means protecting their premium pricing.
But because they operate like a specialized boutique, the next logical question is, how on earth do they survive against the massive global superstores of the alcohol world? I mean, they are competing for shelf space against absolute titans who have endless resources.
Well, they don't just survive, they dominate their specific lane. Within the U.S. premium import beer segment, STZ owns a staggering 73% market share.
73%, that's massive.
It is. To put that dominance into perspective, Heineken is sitting at about 16% share in this niche, and AD InBev is at roughly 1%.
Wait, 1%? Like the global conglomerate that makes Budweiser and Stella Artois only has 1% of this market.
In the U.S. premium import niche, yeah, just 1%.
That's insane.
I know. Global giants like AB InBev and Heineken obviously have massive geographic scale and huge global portfolios. But here in the U.S., they are highly exposed to the structural long-term decline of mainstream domestic lagers.
Right, because consumers have been steadily drinking less of the standard middle-of-the-road domestic beer for years. They're trading up.
Exactly. The Compascope report mentions Molson Coors is actually struggling with this exact same dilemma. They rely heavily on those declining mainstream beers, so they're constantly fighting for volume.
Whereas STZ can just rely on pricing power because people are willing to pay more for a Modelo.
Precisely. And if you look at the major spirits companies, like Diageo, they certainly enjoy strong premium margins, but they compete in an entirely different category. Their strength is, well, it's orthogonal to STZ's core dominance in beer.
Okay, so STZ's competitive advantage is intensely concentrated but highly defensible.
Right.
But hold on, let me challenge that concentration idea. Because is being a one-trick pony, essentially just selling Mexican beer to Americans, actually a superpower? Doesn't that mean if U.S. tastes suddenly shift, they don't have a safety net in Europe or Asia to fall back on the way an AB InBev does?
Oh, it's a massive vulnerability, and it's the central tension of their stock. They have incredibly high concentration risk. The trade-off, however, is that their moat in this highly profitable niche is built on authentic Mexican provenance. You can't easily fake that.
Sure.
Like,
Wow.
a competitor can't just brew a Mexican-style lager in St. Louis and convince consumers it's the same thing. Add to that STZ's deeply entrenched U.S. distribution networks and those proprietary cost advantages from their Mexican breweries, and you have a fortress that is very difficult for a rival to breach.
Okay, fair enough. So they own the niche, but a company still has to grow to keep investors happy, right? How does STZ expand when they already control nearly 3/4 of their specific market?
Well, the growth strategy really hinges on broadening their consumer base. Historically, the bedrock of their sales was the Hispanic consumer. The new frontier is successfully pushing into the non-Hispanic demographic.
And are they actually pulling that off?
The execution here has been remarkable, honestly. Look at Modelo's non-Hispanic share of sales. It grew from about 30% in 2019 to roughly 48% by 2025.
Oh, wow. And I think Corona saw a similar jump, right? Going from about 51% non-Hispanic to 63% in that same time frame.
Exactly.
How did they actually achieve that without alienating their core base?
It mostly comes down to sports marketing and cultural bridging. They aggressively targeted mainstream U.S. sports, UFC sponsorships, massive college football campaigns. They positioned the beer not just as a cultural import, but as the premium choice for an American sports weekend.
That makes sense.
Yeah, and alongside that, they're developing what they call emerging growth engines.
Like Pacifico.
Yes, exactly. Pacifico started as this niche West Coast surfer favorite. Now you're pushing it into national distribution, heavily marketing that distinct yellow can so it visually pops on crowded shelves across the country.
Right, the yellow is very recognizable.
And then you have Victoria, which they're explicitly targeting at a younger 21 to 25-year-old demographic. They're positioning it as a deeply authentic heritage brand to really appeal to Gen Z's desire for authenticity.
Plus, there's the innovation strategy we touched on earlier, leaning into health and moderation trends with low-cal and non-alcoholic options. And they pair all of this with steady, moderate 1% to 2% annual price increases.
Yeah, they do. Even on the wine and spirits side, despite its small size, they are targeting 7.5% annual growth by focusing strictly on high-end retail and premium on-premise accounts, like high-end restaurants.
All of which creates a very clear blueprint for margin expansion. But doesn't this strategy eventually hit a ceiling?
What do you mean?
Like, if you aggressively market a brand like Modelo to everyone in the Midwest, how do you prevent diluting the authentic cultural identity that made the brand so popular in the first place? If it becomes the default beer everywhere, does it lose its premium imported allure?
That is exactly the tightrope STZ walks every single day. The marketing has to remain culturally resonant enough to keep their foundational Hispanic base fiercely loyal, but welcoming enough to invite the rest of the country in.
That sounds tough.
It is. So far, the premium price point has acted as a buffer against it feeling too mass market, but it is a constant balancing act.
Which brings us to the vulnerabilities of turning this paper strategy into reality. Let's talk about execution risk, because a strategy of pushing a highly concentrated portfolio further into the mainstream has some massive blind spots.
Yeah, this is where that geographic concentration really shows its teeth. STZ doesn't have the headache of managing complex operations across 50 different countries with 50 different regulatory environments.
Which, I mean, sounds like a dream for an executive team.
Right, until you realize their entire execution risk is heavily concentrated in one single geographic pair, U.S. demand and Mexican supply. The operational risks in Mexico are severe, primarily centering around water scarcity.
And this isn't just a hypothetical risk either. The Compasscope report noted they actually had a major plant project completely canceled back in 2020 because of water-related public protests and regulatory pushback.
Yeah, that was a huge deal.
That single event delayed their new Veracruz site by 2 full years.
Exactly. It highlights how fragile a single country supply chain can be. And now that the new Veracruz brewery is finally ramping up, it introduces a different kind of financial risk, which is operating leverage.
Explain how that works against them here.
Well, when you build a massive multi-billion-dollar brewery, you take on huge fixed costs. If U.S. demand stays strong and that facility operates at full capacity, it's highly profitable.
Right.
But if demand softens and they have to run that plant under capacity, those fixed costs just don't go away. They become a massive drag, essentially crushing profit margins.
Wait, so if I'm understanding this, it's like they've basically built a custom, highly efficient money printing machine. But the power cord only reaches one specific wall outlet in Mexico.
That's a great analogy.
And if the power goes out at that outlet, whether due to strict new water regulations or political shifts, the whole machine just stops. There is no backup factory in Canada or Europe to pick up the slack.
That analogy hits the nail on the head. And beyond the physical supply chain, investors are also hyper-vigilant about strategic execution risk. In the past, STZ's management meets some highly publicized, value-destructive capital allocation blunders.
Right. You're talking about when they overpaid for the craft brewer Ballast Point and when they poured billions into Canopy Growth, a cannabis company, just before the cannabis market collapsed.
Precisely. They took the massive cash flow generated by their Mexican beer monopoly and essentially set it on fire, chasing trends outside their core competency.
Ouch.
Yeah, the market punished them for it. Investors today demand that they stay disciplined and stick to their beer dominance.
Which leads us perfectly into the real-time data. How are these theoretical risks playing out in the current economic environment? Looking at the transcript from the Q4 2026 earnings call, it sounds like fiscal year 2026 was genuinely a brutal year for them.
It was a very tough stretch. The headline number is that organic sales declined 10% and total beer volume was down 3%.
Wow. And just for anyone not deep in financial jargon, when a company says organic sales dropped 10%, that means if you strip out the effects of currency swings or buying and selling other companies, the core underlying business actually shrank by 10%.
Right.
That is highly unusual for STZ. So what drove that decline?
Basically, two intersecting headwinds. First, there's a broader industry-wide trend toward alcohol moderation. People are simply drinking a bit less.
Okay.
Second, and far more impactful for STZ, was intense macroeconomic stress on their core Hispanic consumer base.
Because inflation disproportionately impacts lower and middle income households, right?
Exactly. And that Hispanic demographic still makes up roughly 40% of STZ sales. When inflation spikes and real wages struggle to keep up, those consumers feel the pinch immediately.
Makes sense.
They might not stop drinking entirely, but they might trade down to a cheaper domestic beer or, just buy a 6-pack instead of a 12-pack. The wine and spirits category also saw a drastic downgrade in its outlook for similar reasons.
But reading the call transcript, management's tone wasn't completely gloomy. They pointed out that they are exiting the year with strong momentum.
Yeah, they did.
They specifically highlighted that Q4 depletions improved. And depletions is essentially industry jargon for the speed at which the product is actually selling out of distributor warehouses and into retail stores. It's a key metric for real consumer demand.
And that demand accelerated as they moved into the spring. March 2026 started significantly better than they had planned. They noted that Pacifico is exploding and Modelo is actually gaining market share across all demographic ZIP codes, despite the broader volume declines.
But all of this is happening during a major leadership transition. Longtime CEO Bill Newlands is stepping down to a strategic advisor role. And on April 13th, Nicholas Fink took over as the new CEO.
Yeah, Fink has been on the STZ board for 5 years, so he knows the machinery intimately. He's promising continuity and capital discipline, but bringing in a new CEO always introduces a layer of execution risk. The market is watching really closely to see if he changes the playbook.
One thing that immediately caught my eye was a major shift in margin guidance under this new leadership. They are guiding for beer operating margins to step down to 37 to 38%, down from their historical 39 to 40% range.
Yeah, that margin compression is the direct result of the operational risks we discussed earlier.
Yeah.
First, they are absorbing the heavy fixed costs of bringing that new Veracruz brewery online in a softer volume environment.
Right.
Second, they're significantly ramping up their marketing spend, pushing it up to 9.5% of total sales.
And a huge chunk of that marketing budget is going specifically to target the upcoming FIFA World Cup to capture consumer momentum, which is just a fascinating corporate tension to me.
How so?
Well, think about this. They just endured a year where core organic sales dropped 10%. Their foundational consumer base is financially stressed. They're bringing in a brand new CEO.
Yeah.
Yet instead of pulling back, cutting costs, and playing it safe, they're throwing massive marketing dollars at the World Cup and ramping up a gigantic new brewery.
It is a very high-stakes, aggressive bet. Management is essentially wagering that the recent headwinds are cyclical. They think the consumer is just temporarily squeezed by inflation rather than there being a permanent structural decline in their core market.
So they're spending now to be ready for the rebound.
Exactly. They are spending now so they're perfectly positioned when the consumer's wallet recovers.
So if you're tracking this company or just watching the alcohol industry at large, what are the key metrics you should be watching over the next few quarters to see if STZ's gamble actually pays off? The Compasscope report lays out 4 massive dominoes.
The first pillar to watch is the structural alcohol trend. We really need to monitor if this sober-curious movement, particularly among Gen Z and younger millennials, is a permanent structural shift away from alcohol, or just a cyclical health phase.
I have to ask for a reality check on that, actually. If Gen Z is truly just drinking less alcohol overall, does pushing non-alcoholic beers like Corona Sunbrew actually replace that lost revenue? Or is the company just doing damage control for a shrinking pie?
Well, it functions as both, honestly. But the industry's ultimate defense against lower volume is premiumization. The math is simple. If consumers are going to drink less frequently, the company's goal is to convince them to spend more money on a higher quality premium product on the occasions they do drink.
Oh, I see.
STZ needs the profit margin on every single bottle to go up to offset the fact that the total number of bottles sold might go down.
That makes the boutique strategy make even more sense. So the second key to watch is the macroeconomic health of the consumer. Specifically, tracking the U.S. inflation rate and the real income recovery of that core Hispanic demographic. If inflation cools and their wallets recover, STZ's volumes will likely bounce back quickly.
The third metric is the Veracruz utilization rate. As we discussed, that plant has massive fixed costs. We have to track if U.S. demand grows fast enough to justify running that New Mexican brewery at high capacity.
And if it doesn't?
If demand stalls out, Veracruz becomes an anchor, dragging down their quarterly earnings.
Makes sense. And finally, leadership discipline. Everyone will be watching if the new CEO, Nicholas Fink, maintains a tightly disciplined balance sheet. Will he focus strictly on maximizing the efficiency of the Mexican beer portfolio? Or will the company get tempted into risky mergers and acquisitions again? I think investors have made it pretty clear. No more cannabis companies.
Yeah, definitely. The market is currently craving boring, predictable, highly efficient execution from Fink. Any deviation from the core beer dominance will be heavily scrutinized.
So let's look back at the ground we've covered today. We explored STZ's completely unique position as the undisputed king of U.S. Mexican imports, basically ignoring the domestic lager playbook entirely.
We did.
We looked at how they are carefully expanding a highly concentrated portfolio into new demographics without losing their cultural authenticity. We broke down the intense execution risks of relying completely on a Mexican supply chain vulnerable to water scarcity, and of course, we examined a massive leadership transition occurring at a truly pivotal moment for consumer spending.
To wrap things up, I want to leave you with a final thought that really builds on everything we've unpacked today.
Let's hear it.
We talked about how STZ is explicitly targeting younger demographics with brands like Victoria because those consumers deeply value its authentic heritage. It suggests a fascinating shift in the landscape.
Yeah, it really does.
Perhaps the future of the global alcohol industry isn't just about who owns the biggest global supply chains, the most factories, or the widest distribution networks. Perhaps the ultimate competitive moat is about who owns the most resilient cultural narratives. As you watch these markets evolve and companies compete for shelf space, ask yourself, when you look at a valuation, are you pricing in the company's physical assets, or are you actually valuing the cultural identity printed on the glass bottle?
It's a great question to end on. Because the next time you're walking down the beverage aisle, looking at all those red, white, and blue cans fighting a losing battle for volume, just remember, sometimes the most profitable way to win the classic American game is to refuse to play it altogether. Thank you so much for joining us on this deep dive. Keep staying curious, keep digging into the numbers, and keep asking great questions about the companies shaping our world. See you next time.
This content is produced by Compasscope.com. For more than 1,100 public-listed companies, find detailed company research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.